What is going on, traders? Welcome back to the Traveling Trader. So there is a potential nightmare scenario brewing in the markets. And hint, no, it doesn't only have to do with the Omicron variant. Although Omicron does sound like an evil transformer of sorts, but he or she is not going to be wreaking havoc on the market alone. So all jokes aside, in this video, I'm going to be telling you what that nightmare scenario is, what you need to pay attention to if you are a serious investor or trader. I will then give you a brief market update and tell you what I think is going to happen in the short to mid-term. And because this channel is not all about doom and gloom, it is actually about results and about finding solutions. So I will be telling you how I'm hedging this market here. If you're a fan of this channel, you know that we've really been opening up hedges since, I would say, around September. And we do this a variety of ways. No, you don't have to be an experienced options trader, although knowing something about options does help. You can still hedge using other tools other than options. So I will give you a variety of things that you can focus on as a trader in order to hedge against this scenario and against any potential downturns. And because I like to end things with a positive and high note, I will be telling you why there could be a golden opportunity right around the corner in certain stocks. So I'll be telling you what I'm looking at and the levels that I'm looking at in order to pick up some cheap, value discounted blue chip quality stocks. So please pay attention to the info in this video and let's get right into it. All right, so before Friday, November 26th, which was the day after Thanksgiving, all seemed fine and well. The market was melting up. We were getting, record numbers in terms of online sales. Mega cap companies and blue chip companies were reporting better than expected earnings, mostly across the board. We had the lowest jobless claim since the pandemic started. And per the Fed meeting minutes, the Fed was ready to start tapering soon because they saw growth in the economy. And they're like, okay, it's time to pull back some of these asset purchases because we don't want inflation to run amok and the economy is doing well on its own. So we're going to be withdrawing our support more and more. Now, for the newbies, what tapering means is basically the Fed comes in and purchases assets every single month in the form of treasuries, mortgage-backed securities, and other fixed assets in order to prop up the market. Because if they don't do this, then interest rates are going to run high. And when interest rates start going up, cash is taken out of the economy. Because think about it, right? Let's think about it from a beginner standpoint or from, I guess, a layman standpoint. Imagine your bank calls you up and says, hey, the interest rates right now are really high and you can get a lot for your money. Well, instead of spending your money, you're going to be saving some of that cash because now the interest rates seem lucrative for you to store away some of your money. So that's why you are withdrawing money out of the economy. Also, from a business standpoint, when interest rates are low, the cost of borrowing money is very attractive. So they're able to expand business operations. They're able to borrow money cheaply to use it for other things. But if interest rates start running high, then businesses are less likely to borrow money because now it costs a lot in order to borrow that money. So again, you are basically stifling the economy when interest rates are high. That is why the Fed, during times of distress, comes in and starts buying up assets in order to keep our interest rates artificially low. Well, now because inflation runs the risk of going crazy and the economy is actually growing, jobless claims are lower than they were since the pandemic started, the Fed announced that they're going to start scaling back on that tapering slowly. Now, aside from tapering, another thing the Fed can do in order to raise rates is actually raise the federal interest rate. And some Fed members are even gung-ho on raising rates very soon. The problem is when a lot of experienced economists were calling on the Fed to do this earlier as the market started running hot, as the economy was growing, now the economy has peaked and it looks like there will be a slowdown, especially post-holiday rally, right? And now we have the Omicron variant, which is going to potentially drop the market further as it causes panic. So we are bound to get a slowdown in global growth. This is when you don't want to start tapering or raise rates. And you want to know what's crazy about this whole scenario? This very same thing happened already in 2018. Now, the circumstances were a bit different because we weren't reeling from a pandemic. However, in 2018, the Fed in their Fed minutes said, hey, in order to curb inflation, we have to start raising rates. However, the economy started slowing down at the end of 2018 and the market started dipping. For those of you that are not newbies in the market, you will remember the almost bear market that we saw in 2018. We missed a bear market by less than a percentage, depending on which index you are looking at. But in the Fed minutes, they're like, hey, yeah, we think it's time to raise rates. And, per some experts, they did it a little too late. And then when the market started tanking in the actual FOMC meeting, which at the time of this recording is going to happen on December 15th, they're like, no, okay. sorry, we take everything we said back, and then the market started rallying again. So between now and December 15th, I think the Fed will have a lot of thinking to do, and we might see a reversal on the tapering decision. If we don't, then you can expect a correction in the market, in my view, because we are now going to start tapering and potentially raise rates during a period of slowed down economic growth, not only in the United States, but globally. So even aside from Omicron, the situation looks bleak if we do see a slowdown in the global economy and the Fed decides to taper and or raise rates during that economic slowdown. Back in 2018, when we saw that almost bear market, the S&P PE ratio was almost 33. And right now we're currently at almost 39. And this is the highest it's ever been, only to be beaten out by the dot-com bubble in the year 2000. So if you take a look at the SPY here, you can see that obviously we made all-time highs last week during the low volume trading week of Thanksgiving. And we are now below the 21 EMA on the daily. The RSI looks like it's dropping like a rock. And the MACD looks like it has turned bearish as well. In my view, we will likely at least retest the highs that we saw back in September, which was near the 50-day moving average on the SPY of around $451. So in my view, most of the stock market is not at a buying opportunity right now. I mean, if you zoom out and you take a look at where we are, we're still near all-time highs, right? Like, this is just a drop in the ocean. So I think this is definitely a wait and see moment here. Now, at the time of this recording, news just came out that Moderna said they could be ready for an Omicron variant vaccine in early 2022. So if we find that the Omicron variant is not as dangerous and it passes, really it passes by unscathed just like Delta did, or if they find that variant is easily isolated and that variant can be taken care of by a booster vaccine of some sort, then I don't think that, Omicron is really going to be the havoc-wreaking effect on the market. I do think that Fed policy is more dangerous to the market than Omicron is at the moment, based on all of the news that we know about so far. All right, so what can you do to hedge against your portfolio? Well, if you hold stocks that are primarily in the S&P 500 or in the NASDAQ. So if you take a look, I'm just going to be using Thinkorswim's Market Watch tool. If you look at the Visualize tab, there's something that's really useful here. If you click on the indices, you can actually see what stocks are in each of the indexes. This is the NASDAQ 100. So the bigger the square is, or the rectangle is, the more of the share of the index that stock takes up. So you can see that the NASDAQ is mostly made up of Microsoft, Apple, Google, Amazon, Tesla, Nvidia. But if most of your portfolio looks like this, then it makes sense, in my view, to either sell calls against your shares if you have at least 100 shares of each stock. So if you had 100 shares of Microsoft, you could sell covered calls against your shares. You could pick a pretty conservative strike price, which was basically the recent high that the stock hit. So if you look at Microsoft, for instance, I would be looking to sell the 340 or 345 call against my shares. Same thing goes for Apple. Same thing goes for whatever stock. I personally sold the 1,300 calls against Tesla. I did that a couple of weeks ago. And if you want access to all of our trades, link is in the description. But we also have a bearish play on Apple as well. We sold a call spread on Apple, which is also a bearish position and doesn't require you to have 100 shares of that stock. So 1, you could sell covered calls. 2, you could sell call spreads. 3, you can buy what are called protective puts as insurance. So in this case, for instance, if we go out to, let's say, the SPY, and you think that the indexes are going to drop, or you want to buy some insurance against your shares, and you have enough stocks that resemble the S&P 500, right? Most of your portfolio is made up of stocks that are in the S&P 500. Then you can go out to the monthly options like December 17th, and you could buy these protective puts here. I would go pretty close to in the money, and you don't have to make this a huge percentage of your portfolio. So this isn't going to be a main position. You are basically buying insurance. When you buy car insurance, you don't buy car insurance that is equivalent to the value of your car, right? It costs you a fraction of what your car's value is per month. So in this case, you could buy the 455 puts against the SPY, expiring December 17th as an example. You can also do this against your individual shares. So back to the Apple Microsoft example, if you thought that Apple hit a roadblock currently because of what I just talked about in terms of the market potentially downturning, you could say buy the 155 put against your shares, and you don't need to have 100 shares of stock to do this. Now, what if you don't want to trade options? What else can you do? Well, you could buy inverse ETFs. So we have inverse ETFs that trade against the index. So when the index goes down, that inverse ETF goes up. There's something called the SPXS, which is the index ETF, the inverse ETF that trades against the SPY. So when the SPY goes down or when the S&P goes down, the SPXS goes up. There's one that is inverse to the NASDAQ, which is called the SQQQ, same thing. When the NASDAQ goes down, this goes up as well. But these aren't positions to hold long term. These are just short term positions if you're looking to buy some insurance and your portfolio has a lot of the stocks that are in these indices. If your portfolio in and of itself is made up of, sorry to say, but made up of shit stocks, like if most of your portfolio is made up of Fubo, DraftKings, a bunch of SPACs, etc., then it does not make sense to do this. Now, one thing that I'm also looking to hedge is energy, because we will likely see a drop in oil prices if the market continues to turn down. You see this double top forming on the XLE. If you have XLE shares, you could sell calls against your SLE shares, or you could buy puts on the XLE, or you can even sell a call spread on the XLE, which doesn't require you to have 100 shares. There is also an inverse ETF against crude oil called SCO. Again, you don't want to hold this long term. This is a leveraged ETF, so these are definitely made for shorter term plays to hedge against your portfolio. And lastly, I think there will be a golden opportunity in the stock market. I've said this before, but even if we fall, let's just say that we fall to, 451 or 452 on the S&P 500, that was the all-time high just a few weeks ago, right? If we fall all the way down to 430, which is below the 100-day moving average, it will seem like panic in the streets, but that was basically the all-time high in July, all time, like ever. So a lot of you that feel like you missed out on the correction that occurred back in September or the correction that occurred in October 2020, those were extremely lucrative buying opportunities. You can use that as a chance to rotate into quality stocks and fix up your portfolio a little bit. And two industries that I think are secular to a market drop. Obviously, these stocks can drop as well, but these stocks are, in my view, non-cyclical, meaning it doesn't matter what the stock market is doing. If I can pick these up at a discount, I will. One is the internet security sector, and two is the semiconductor sector. So stocks like Palo Alto Networks, Zscaler, C Limited, which is SE, SailPoint Technologies. These are stocks that I think should be pickups in anyone's portfolio if we can get them at a major discount. And then obviously semiconductor stocks like AMD, Nvidia, stocks that a lot of folks did miss and wish they were in. There could be a tangible opportunity there if we do see a market correction. You also have the two semiconductor ETFs, SOXL and SOXX. Those I will be looking to see if we can get them at the major moving averages, like the 50-day moving average. In my view, a must-buy long-term opportunity there. Anyway, traders, that is it for this video. In conclusion, if the Fed does start tapering in a period of economic downturn globally, and if Omicron is actually the variant that everyone fears, if it turns out to be that, then we could be in for a nightmare scenario in the markets, and we could see a correction potentially near bear market, which is 20% or greater of a drop. We could near that 20%. I personally don't think we will get a 20% drop, but we could see a similar scenario to 2018 where we almost got there. But that could be a golden opportunity to start reshaping your portfolio into the portfolio you've always wanted it to be. And in terms of secular or agnostic stocks that I'm looking at right now, I'm looking at the internet security firms as well as the semiconductor firms. There will obviously be others, and I will be making video updates. If you get anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know what you think of the potential market downturn. Let me know what stocks you are picking, what stocks you are playing. If you want access to all of our trades, hedges, portfolio stocks, options, crypto, etc., link is in the description below. Would love to have you. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.